Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's webinar on key considerations in audit of renewable energy sector. As we all are aware that the topic is very relevant and very important in today's time, and that is why we at the panel of AASB we are organizing this today's webinar. And in order to tackle this very important topic, we are having with us very learned speaker, C.A. Shraddha Khivsaraji. So, on behalf of AASP of ICI, I extend our warm welcome to you, ma'am, on this webinar organized by AASP of ICI. Namaste, ma'am. Welcome to you.
Thank you, sir.
I
Thank
also
you.
welcome. I also welcome all the participants of today's webinar. Before we formally start, it is my proud privilege to share with all of you the brief profile of our today's learned speaker, C.A. Shraddha Khivsaraji. See, Shraddha is a chartered accountant and company secretary with over 12 years of rich experience in conducting statutory audit of automotive, manufacturing, engineering, renewable energy, IT, and tech clients. She has managed audit of large listed group companies which are part of Sensex 30 and Nifty 50. He has led Ind-AS implementation of one of the leading automobile and private sector pharma company. She has spearheaded audit of standalone and consolidated financial statements of multiple listed private limited, public limited, and global companies by conducting statutory audit as per Indian GAAP. She has delivered trainings on in accounting and auditing standards, which were effective leader with excellent motivational skills to sustain growth momentum while motivational peak in individual performances. She is trusted advisor to the clients on various complex issues and practical and solution oriented approach with compromising audit quality. She is the company secretary for Institute of Company Secretaries in the year 2009 and a chartered accountant from ICI. Is qualified in a first attempt in 2008. MCOM from University of Pune in 2009, BCom from University of Pune in 2006, 2007, and diploma in IFRS from Akka UK in 2010. So still list is very vast, and the very core competencies: statutory audit, exceptional clients, business development, cost reduction, process improvement, sustainable client relationships, quality and compliance, learning and development, project management, team leading, building and leadership. So once again, welcome to you, ma'am, in this webinar organized by AASB. So without wasting much more time, I request madam to please start our deliberation. Over to you, ma'am, please.
Thank you, Anilji, for the brief introduction. I would like to first thank AASB to give me an opportunity to present on this very important and relevant topic in today's times. So, good evening, all my dear friends. Now, you would be thinking, why a webinar on renewable energy sector? So, as we all are aware, India is a country with 1.3 billion population. Our energy consumption levels are very high. Considering the past 7 decades, that is prior to independence, where we were a power deficit country, today we have moved to a power surplus nation. Considering the current global warming issues, climate related changes, India's commitment towards making a sustainable development and a sustainable move towards the to the entire world, uh, renewable energy sector has emerged as one of the top leading sectors from a government perspective. There have been lot of traction in this sector, where there are a lot of government initiatives which have been taken. There are a lot of business houses which has come forward to make investment in this particular sector. Private equity has made a lot of investment in this sector, and therefore you will see that the move towards a better, a cleaner, and a greener energy has become very important in today's times. India today believes that by 2070, it would want to become a net zero carbon emission economy. And considering that renewable energy is a sector where there has been a lot of focus and government policies which have come into the place. So basically, the sector offers a lot of investment opportunity for businesses, as well as a lot of employment opportunity, and so does the audit comes into picture. So as these companies are growing, as a lot of promoters, a lot of business houses are investing in renewable energy sector, we as an auditor, it is very important that we understand what are the nitty-gritties when we audit renewable energy companies. So before we go into deep into the auditing part of this, I would like to first highlight what this sector is all about, where we as a country are contributing in renewable energy sector. How is the sector generally structured? What type of structure you will find in the companies when you will start auditing the renewable energy sector? And then we will look at the audit specific risks, sector specific risks, and the audit procedure which an auditor should perform. So if we look at the various sources of renewable energy, there are six, I would say, six large sources of renewable energy, which includes solar. Now, solar is something which everybody would be aware. Solar is the largest source of renewable energy. If you look at the total installed renewable energy capacity in the country, solar is almost 61 gigawatt as we speak today. So solar is largest form of renewable energy from an installed capacity perspective in India. If we look at the wind, so wind basically harnessing the power of the air, or the harnessing electricity from the air. Windmills are generally used to generate renewable energy. So that is another, or I would say, second largest source of renewable energy, wherein the installed capacity stand at around 42 gigawatts, which is a huge installed capacity in the country. Hydro is kind of hydroelectric. Again, hydroelectric source has been there for long, I would say very long. It's a old source of renewable energy. Hydroelectric, again, using the water which is falling from, say, streams, or the flowing water in the dams. That is the power or the motion of that is used to generate electricity. That is hydro. Bioenergy, again, the organic, the plants, food, all biodegradables are used to generate renewable energy source. Green hydrogen, this is something which I would say not very new, but yes, there has been a lot of focus on hydrogen, generation of renewable energy from hydrogen, wherein the hydrogen is used in a way where green energy gets generated, stored, and supplied. That is another source of renewable. And then waste to energy. Now, what is waste to energy? Anything which is waste is used to generate a renewable energy. That is nothing but a waste to energy. So these are broadly six sources of renewable energy. But if we look at the sector, you will find players in solar and wind sector, because that is the sector which has large potential as well as large installed capacity as we speak. So hydrogen is another upcoming thing. Rest of the sources are not very big, but they are as well growing. But solar and wind dominates the renewable energy sector. So our today's discussion predominantly would be around how to audit a company which has ventured into solar generation or wind power generation. Let's look at few key statistics of the sector. So as I mentioned in the introduction, that there has lot of been focus on this sector, considering the need for a sustainable development and a sustainable future, as well as our increasing demand for energy. There has been a lot of focus on renewable energy. So if we look at it, India market has a potential of 1,000 plus gigawatt. So that's a huge potential. And because of that, there has been a lot of investment and traction in the sector. So if we look at it today, we have 173 gigawatt installed, whereas the potential is more than 1,000 plus gigawatt. So that's a huge potential, where I would say currently as we stand, though a lot has been done, but there is a lot of investment which would come in this sector, or a lot of installations which you will see in future in this sector. India, as we speak, from an energy consumption perspective, India is the third largest country in consumption of any energy. If we look at the installed capacity of renewable energy, India has the fourth largest installed capacity of renewable energy in the world. So we are fourth for wind, we are fourth for solar, and overall also our installed capacity is fourth in the world today. From a government perspective, at COP26, government had made a promise of reaching an ambitious target of 500 gigawatt of non-fossil energy by 2030. So if you look at today's times, which is 2023, we have already reached 173. However, in 7 years, the target is to reach 500 gigawatt. So basically, the growth which you will see in the sector, the number of companies, number of projects which you will see in this sector would multiply every coming years, considering the country's target of 500 gigawatt. As we speak today, the share of total installed capacity of renewable energy in India's total energy consumption is around 40%. So 40% is the renewable energy sources out of the total energy consumption of India. Now, what are the key growth drivers for the Indian renewable sector? So we already saw that sector offers a lot of potential. Sector is quite attractive for business houses as well as for private equity. But what are the growth drivers? So if you look at it, India's energy consumption demand is increasing day by day, and it is expected to increase by 1.8 times by 2030. So at the increase in demand is exponential at a CAGR of 6% by 2030. Having said that, the country already has target on hand to reduce the carbon emission. So India targets to reduce the total projected carbon emission by 1 billion tons by 2030. So one, we have current target emissions, we have current carbon emissions, plus we target to reduce those in the increasing demand consumption. So therefore, the growth potential for the sector multiplies. Plus, we target to have a total installed capacity of 50% by 2030. So today we are at 42%. We target to reach 50%, or the sources of renewable energy would be 50% of the total energy consumption by 2030. Having said that, as a country, we target to achieve net zero carbon emission by 2070. So all these targets which we have to make a sustainable development, to make contribute towards the cleaner and a better earth, and to reduce the climate related concerns, are itself very important growth drivers for the entire sector. If we look at the government initiatives, so as I mentioned, government is coming out with a lot of policies in this particular sector, considering there have been a lot of targets which have been set, and the country is working on it to reach those targets of 500 gigawatt. So there has been a lot of policy initiatives which have been taken. So earlier, if you look at this sector, generally, when we speak about the solar energy, generally the solar modules which are used to generate that energy were imported from various countries, which was largely China. Now, considering the potential and considering the Atmanirbhar Bharat Abhiyan which government is carrying out, so government has come up with a PLI scheme. Under the PLI scheme, for the manufacturer of photovoltaic cells, which are those solar panels or solar PV modules, the way they call it for the in the industry, there has been a PSI scheme which has been rolled out, which will help the business houses to set up the domestic manufacturing of PV modules which are currently imported. So that is a huge announcement which has been recently made by government for, I would say, domestic manufacturing of solar photovoltaic modules. Another key initiative is this sector is completely open for 100% FDI. So 100% FDI under automatic route is allowed in this particular sector. Other than that, there have been a lot of different schemes like National Hydrogen Mission, National Wind Solar Power Policy. Different schemes have been brought into by government to make sure that it becomes easier for the developers to have the to install the solar power plant or to install a wind power plant. So all these policies have been brought into picture, PLI being a very recent one and very important one, considering the entire economics and the entire dynamics of the sector changes as soon as the companies start using the domestic PV modules as compared to the imported ones. So these are few key government initiatives which government has taken to make sure or to boost the growth or the investment in this particular sector. Now let's look at the industry structure. How does this industry generally operates? So generally what happens in a renewable energy sector, there is a competitive bidding mechanism. So government comes up with the competitive bidding and the lowest bid, these are all online bids, and the lowest bid wins it. So that is how generally the sector operates. Having said that, there is also another mechanism wherein few companies uh, build the solar and the wind power and sell it to the private customers or the private commercial industry. That is another way in which renewable energy is generated and sold. You will find first being the very predominant sector because those are large projects where government awards the project and then the discoms, different state discoms purchase that energy from the developer of the power. So the way the industry functions is there is an OEM manufacturer. Now OEM manufacturer is a basically as we spoke about solar module manufacturer or solar photovoltaic cells manufacturer, wind blade manufacturer. He is a person who would manufacture the major equipment and sell it to the generator or sell it to the producer of wind or solar energy. Now, generally, companies have different ways in which they handle this project. So when based on the competitive bidding, when these projects are won, either the company develops the project on its own. So they have in-house team who will install or who will construct the project, or they subcontract it to a contractor, and it's similar to like a turnkey project where they will subcontract it to a contractor. The contractor will take care of the entire construction of the project, and once the entire project is ready, he will hand it over to the developer. So that is also a predominantly common model. So some have in-house subcontracting team, some subcontracted to the third party. So these subcontractors generally do the entire construction work of the project, which includes the installation of the panels as well as the windmills, etc. And then comes the RE generator or the developer who enters into the power purchase agreement with the government. So basically, this generator is the one who would have done the bidding, won that bidding largely, and then enter into an agreement with the customer and supplies power to the customer. If there is no competitive route which is followed, so if they don't, if the generator has to develop the site on his own, that also can be done. He will sell it to the customer identified by him. So in that scenario, the customer would not be government party or would not be a discom, but it would be any customer which he would have specifically identified. And then last in the chain is the discom who would buy the power from the RE generator. So largely here I would want to demonstrate that these are various parties in the entire value chain of power renewable energy power generation. A lot of our discussion today is going to be focused on the subcontractor element and the power generator. So how do we audit, or what are the nitty-gritties which we should take in mind, or what are the key considerations which we should keep in mind when we are auditing these entities? If we look at the key consideration, so for an auditing any company, you start with planning for that audit. So it is very critical that we understand the business of that entity. So as I mentioned to you, there are various sources of renewable energy, plus there are various ways in which a company would operate. So it is very important that we understand the business, we understand how that particular company is operating. One more important thing about this industry is generally you will find that one company, the company will operate through various subsidiaries. So you will find generally one project in one company or one SPV, so as to say, and then there are multiple such entities. There is a holding company, there are multiple subsidiaries which are formed, and each subsidiary would then have its own project which it would be executing. Largely, I have seen that type of structure being followed by the companies. So generally, you will find that when you are auditing any renewable energy group, it will not be one or two entities. Largely, it would be multiple entities because a group would have different subsidiaries to cater to different projects. That is how the business is structured in this particular sector. So therefore, it is very important that we understand the business of that company, what all sources or what all projects they have, with whom they have those projects, because different projects will carry different risks. An under construction project, or when I say under construction project, largely means company which has won a project from the government, but it is yet to be constructed. It is under construction phase. That company will have a different risk as compared to a company which has not yet won the project, but it is in the process of bidding. So it is submitting the bids, but it is yet to win the project. Or an entity which has already won the project, constructed, and is appropriately operating the projects, which is an operational asset. So the risk in an under construction asset would be different than a risk which would be then in an operational asset. Therefore, it is important that we understand. Plus the risk which would be there when there would be a power purchase agreement with government, as compared to be having a private power purchase agreement with, say, third parties or any business house. There also the risk would comparatively differ. And therefore, this understanding of business element is very, very critical. Now, as I mentioned to you, that there could be different type of entities. It could be company which is bidding, but yet to win the project. It could be a under construction. It could be an operational asset. Now, when it comes to determination of materiality, the type of entity is very, very important. Because what will happen is, for an under construction company, there would be hardly any PBT. PBT may not be relevant. Their total assets may be a relevant source or maybe a relevant base for determination of materiality. However, when it comes to an operational asset, PBT or EBITDA margin, so to say, would be an appropriate basis to determine the materiality. When it comes to entities which are still in the bidding process, which are yet to win the projects, their total expenses may be a more reasonable and more a rational basis to be considered for determining the materiality. So do the understanding of business, look at the nature of the asset, whether it's operational under construction, and then decide what should be the basis on which materiality should be computed. So that is very, very critical and first step when you start the audit of the company. Then let's move to understanding of significant business processes. As we understand, considering the requirements of internal control over financial reporting as well as the auditing standard, we need to understand the significant business processes. Now, from an renewable energy sector perspective, the business processes largely remain same. However, the property, plant and equipment process is very, very important if the entity is in the construction phase. Similarly, purchase to pay process also becomes very important if the entity is in-house developing the project and it is under the construction phase. Now, in this particular sector, one more thing which you will commonly find is, generally you will find these sectors are very leveraged ones, where the debt component would be quite high. So generally you will find 70 to 75% of debt and 25 to 30% of equity being invested by the shareholder. So considering these are highly leveraged companies, again, borrowings and treasury aspect becomes very, very important. So these are few key significant business processes for which an auditor should obtain an understanding before you start the audit of the entity. Another important point to keep in mind is, if you are auditing group of companies, so as I said, generally you will have a holding company and various SPVs which would be carrying out these projects. You will find that there would be group of entities, and the controls around the group of entities would be similar. Similar people would be performing the work for all the entities together, and it would be exactly same process. So from an ICFR standpoint, you need to assess whether you can treat the entire group or the entire population as homogeneous and test the controls and issue an ICFR opinion. So that is another judgment an auditor needs to exercise and assess basis the situation. So that is very, very important point to keep in mind, where you will find homogeneous processes, same people operating the controls across the group, and the process is exactly similar, the business is exactly similar. Auditors should assess that aspect from an ICFR reporting perspective as well. So these are very, I would say, important considerations which an auditor should keep in mind when he is planning an audit. So understand the business, look at the materiality, and then identify the significant business processes. Once that is done, we can look at the sector risk or assessment of risk for that particular company. Now, what I have done here is I have tabulated, or I have included few common risks which are there across the sector. But having said that, basis your understanding of the business, there could be n number of risks which your entity may have, which may not be captured here. You need to assess each risk, decide what is relevant for the set of client which you are auditing, and then see whether it is a business risk or whether it is an audit risk or whether it is both. Generally, there could be some risk which would be only business risk but not audit risk. But you will find generally all audit risk would be a business risk as well. So you need to do a categorization of all the, first you need to identify the risk and then need to do categorization, which are those risks which are very critical from financial statement standpoint. So if we have to look at the sector risk, raw material risk. Now what happens is, as I mentioned, that for solar industries, there is a lot of dependency on this. So silicon wafer or solar cells or photovoltaic solar cells, so to say. The prices of these cells steeply keep on increasing or decreasing. So the prices keep on changing. There's a lot of fluctuation in the prices, and this impact the viability of a project. So when a project is entered into, or when a company does a competitive bidding, there is a set of pricing which it may consider while bidding the project. There would be a set of margin it may expect from that project, and basis that he may quote a particular price after the bid is won, but before the setup of that project. If the module prices changes significantly, because these are time bound projects, so there is a time which is attached to that project as per the agreement. So in that time frame, if the prices of the solar modules significantly differs or changes, the project may turn out to be less profitable, or at times may turn out to be not very viable as well. So this is very important risk which you should keep in mind. And we will discuss on this more when we will be translating and looking at it from a financial statement standpoint. Another risk is liquidity. So as I already mentioned, that this is very highly leveraged sector where the companies do take a lot of debts, and therefore any change in the economics of the project. So take an example where a company may be expecting a 16% margin, but any change in economics of PV modules, any change in forex, any change in any other cost structure may put some crunch, may result into any liquidity impact or liquidity crunch on the company. So liquidity, debt repayment, this is a very important risk from the sector perspective, considering that debt component is very high in the sector. Project management risk. Now, as I mentioned, that project management, as and when the project is won, some companies do offload the construction of project part to a third party subcontractor who will construct it on behalf of the company. Some companies does have group companies who do it for them, or have their own entities who will commission the project and hand it over. Now, commissioning of project, if it is not done on time, there are a lot of penalties which are mentioned in the agreement, or there are a lot of penalties which are there attached in the agreement. So commissioning, if not done on time, will also result into a loss. So if you are auditing any, say, under construction company where the project has just been won and construction is ongoing, there, if you see any delay from a schedule perspective, do assess the risk of penalties or liquidated damages. Generally, in the sector, it is called as liquidated damages. So those risks need to be assessed from a financial statement perspective. Regulatory risk. there are various norms which are there for companies which are operating in this sector. So from a generation perspective, transmission perspective, there are various norms which are there. So if these norms are not complied with appropriately, again, there is a regulatory risk of lot of penalties being imposed. So that is another important aspect which should be kept in mind. Competition risk. Now, this is very, very important. As I mentioned that it is a competitive bidding, and a lot of business houses as well as private equity players have entered this market considering the potential, considering each business houses do have their own ESG targets as well. Considering all that, there has been very, very sharp competition in this sector. And therefore, because of the sharp competition, the prices or the lowest bid at times may be quite low, which may in turn impact the return. So competition risk is very, very important, needs to be assessed, that when a company has won a project, at what rate it has won a project, and whether they have done a detailed analysis, whether the project is profitable and viable at that particular rate. That is another important aspect which needs to be looked at. Technology risk. This is again something very important. If you look at the sector, the way there has been a shift in technology in the solar modules, the way maintenance has shifted. Earlier, the solar modules used to be cleaned by a O&M team. Now there are robotic cleaners which are installed. So there has been a lot of shift in the technology, so to say. So because of the steep change in the technology, if the machines or the technology used by the company in the older project is old one and becomes redundant, that again poses a risk, because when a company would have invested into a project, there would have a lot of money which would have gone into constructing that project. So in case there is a steep change in technology, and the technology which company is currently using, the modules which company is currently using becomes very redundant or becomes very old, that again poses a significant risk from a company perspective. Therefore, technology risk is also very, very important and needs to be looked into. So these are few sector specific risks which I have identified. Having said that, there would be few further risk as well. For example, to install a project, there would be a need of land. So whether there is an appropriate availability of land, that is another risk which a business would look into. Whether that land titles are clear, whether there is any litigation risk around that land title, that is another risk which needs to be looked into. So there are various risks which are there, and from a company to company, those risks would differ. But these are few common risks which you will find in this particular sector. Now let's move to from risks from an audit perspective, or I would say focus areas from an audit perspective. So we already looked at how do we plan the audit for a renewable energy company. Then we looked at the sector specific risks which are there in the sector. And now let's look at the key focus areas from an audit standpoint. So after we understand the business and do our risk assessment, we would be looking at the financial statements of the company, and there would be few captions or few, I would say, few areas where the focus of our audit would be very high. And what I have tried to do here is I have tabulated those areas, and then we will dwell upon each of these areas, that why a special focus needs to be given and what should be specific audit procedures which an auditor should perform in that particular area. So if we start with the risk perspective or the audit focus areas perspective, impairment of property, plant and equipment. Now, a lot of you all will think about why impairment has been considered as a audit focus area. Now, as I mentioned, this being a competitive bidding industry, lowest bid winning the prices, commodity or raw material prices being a lot of fluctuation being there, a lot of technological advancement being there. It is very important as an auditor to assess that the property, plant and equipment value, or which is stated at cost, is appropriate, and there is no need for impairment of that. Considering that is the single largest asset which would be there in the balance sheet, it is very important that this assessment is done by an auditor, generally on an annual basis. Another important area would be revenue recognition. Now, revenue from an auditing perspective, though being a significant fraud risk, If you look at the renewable energy sector, generally it is not very complex, because what happens is there is a power purchase agreement which is signed by the company with the discom or with the customer. So that power purchase agreement has all the terms and conditions, including the tariff, how much is required, minimum capacity which is required to be generated and transmitted. So generally you will find one invoice being raised every month based on the generation for that particular month. And that generation is generally based on the meter reading, which is certified by both the parties. However, having said that, there are certain variable considerations. So if your client is required to follow Ind AS or has optionally decided to follow Ind AS, there are a lot of nuances around variable considerations. Uh, Recently, what had happened was when GST was implemented in 2017, plus when safeguard duty was levied on the purchase of modules, what has government come up with was a concept called as change in law. So because there was a change in law and the projects which were won by the bidders should not become unviable because of taxes, government had allowed the reimbursement of extra cost on account of taxes which were levied for the projects which were already won in a particular time frame. So how to treat the reimbursement of GST or safeguard duty was a question which was being debated in the industry. And there have been various views or judgments which were taken. So in a particular fact pattern, it is very important to assess whether the reimbursement of the taxes is a revenue, or reimbursement of taxes is something which needs an adjustment to the property, plant and equipment. Largely the view which prevailed in the industry was it was a revenue under Ind AS, considering it was arising out of the contract from customer, and it was not the reimbursement of pure reduction from pure property, plant and equipment. So such type of items or such type of variable issues keep on coming, and therefore revenue recognition is another area which should be focused upon. Another key area which should be looked into is around impairment of investments and loan given to subsidiaries or joint ventures. So as I mentioned, that generally you will find a holding company, in the structure you will find a holding company, and then there are multiple subsidiaries, joint ventures or associates which are there. So when a company would be investing in the subsidiary or joint venture, if the performance of that subsidiary joint venture is not up to the par, or if the financial condition is not up to the par, or if the subsidiary would have incurred losses because of some reason or has not been able to win the project, and there are a lot of expenditure which is incurred for bidding on those projects, and impairment assessment is required to be done for those entities. So in case there is any indicator of loss, negative net worth, all such indicators needs to be assessed, and then in case required, an impairment assessment is required to be done for investments which are made. Another important point is loans which are given. So generally you will find holding company giving a lot of loans to the subsidiaries. So whenever such loans are given, impairment assessment not only of investment but also loans which are given is required to be done. Another important area is regarding capitalization of project. As we saw that the company is required to set up a project basis which it will then generate and sell the power. Setting up of the cost of setting up of that project, the entire capitalization process becomes very, very critical. And therefore, capitalization of projects is an important area which should be looked into. Liquidated damages. I just very briefly touched upon liquidated damages in the risk section. So what happens is there are two types of liquidated damages. One, liquidated damage which a company may need to pay to the customer if the company is unable to set up the project on time. And another one is if a company has subcontracted the project setup to a vendor, if the vendor defaults in any of the conditions, again, then there are triggers for liquidated damages. The accounting of liquidated damages is also a bit tricky at times basis the terms and condition and need to be looked upon. Another focus area is around borrowings. Since it's a highly debt leveraged sector, borrowings is another area which should be looked by the auditor very carefully. Litigations, because of the regulatory risk and compliance risk, there could be various litigations around land, right of way, right of use of land, direct taxes, indirect taxes, transmission charges, etc. These are common litigations which are found in this industry. So these litigations also needs to be looked by an auditor carefully. Business combination. So you will find a lot of companies do grow by acquiring smaller companies or another company. So business combination is one common feature in this particular sector. So whenever a business is acquired, whether it's a business combination, it's a business acquisition, asset acquisition, a lot of judgment is required to be, I would say, required to be made by an auditor as well as management, and therefore this area is very, very critical, especially if your client is on India's. Another important aspect is on deferred tax asset. So if a company is recognizing deferred tax asset, whether those are recoverable, whether the virtual certainty lies, that is another aspect which needs to be looked at very clearly, very closely. Now, what we would do is on each of these topic, I would briefly talk about the audit procedure which an auditor should perform. So we already discussed about why these are considered as key focus area or what are the risks in this particular area. Now let's look at the audit procedures which an auditor should ideally perform while working on this particular area. So we spoke about impairment assessment of property, plant and equipment and why it is important that an auditor looks at impairment. But now what audit procedure will an auditor perform? So generally for each project, management should prepare an impairment assessment or an impairment analysis. Now when an impairment assessment is performed, it is performed based on various assumptions. And there are few key assumptions which would which would be highly sensitive, basis which the impairment assessment could be performed. So those assumptions include the discount rate. So what is the debt equity ratio which is considered? What is the equity rate which is considered? What is the debt rate which is considered? These are very, very important assumptions which are critical in the impairment analysis. Another important part is future cash flows. How has the future cash flows been prepared or the future cash flow model being prepared by the company? So in this industry, considering the rate is fixed, what is variable is generation of units. And then therefore, considering the generation, expected generation, the company can easily arrive at the revenue and the future cash flows. So what is the generation which is expected, whether it is achievable, whether as per past that generation has been achieved, why management believes that generation seems reasonable. These are all the aspects which an auditor should review as a part of reviewing the key assumptions. Wherever the complexity is there, it is important that we involve the specialist, the evaluation specialist to review the impairment working which is prepared by management. Once the impairment workings are reviewed, key assumptions are reviewed, it is important that we as an auditor perform a sensitivity analysis. So we should consider changes in the key assumptions or very sensitive assumptions, and then assess whether there is a impairment which is getting triggered after changing few key assumptions. So that assessment should be done by an auditor, should be wherever possible being should be done by the internal auditor specialist, which would be a valuation specialist. See what is the headroom, whether there is a risk of impairment, whether there is a need to communicate it to those charged with governance. In case of impairment, whether an adjustment is required in the financial statement. All those aspects needs to be clearly looked at, very closely looked at, and then concluded. So impairment assessment, keep 2-3 things in mind, look at the key assumptions, involve the valuation specialist, perform a sensitivity analysis. And in case your client has adopted Ind AS, do mention this as a part of the critical estimates and judgments which are used by the management in preparation of financial statement. And then assess the headroom and conclude basis the conclusions or basis the analysis which is performed. Let's move to the next focus area, revenue recognition. As I mentioned that revenue recognition, there would be a power purchase agreement which would be entered with the customer. Now, there are n number of terms and conditions which are mentioned in the agreement, and these are really bulky ones. I would request that as a part of our audit procedures, it is important that we read those power purchase agreement, understand the nitty-gritties, understand the obligation which a company has when it has entered into that agreement with the customer, and consider that while auditing your revenue. Also, what is important is to verify whether the amount has been, whatever has been billed, whether there are any disputes around the units which were generated, whether the billings have been partially paid, whether the entire billing has been paid, what is the pendency, or what, how many months outstanding is there in case of billing which has been done. Generally, you will find that every month would be billed in next couple of days in the to the customer. So basis the state discoms, so every state discom has their own way in which they pay. So some state discom you will find there is no backlog and monthly payments are being released. Certain discoms which are under stress, you will find that there could be some backlog of few months wherein payments are not released. So all that aspect needs to be assessed to say whether the payments are done, whether there is any dispute, whether any amount is being hold, whether any revenue needs to be derecognized. That is another important thing which needs to be looked at. Sometimes what happens is there are, when the tariff is agreed, the rate may not be one. The rate, maybe there would be some changes in the rate after few years, and it would be mentioned in the agreement. How to treat that, whether there is a need to straight line those rates is something which also needs to be assessed from a accounting standard perspective. Another aspect, as we spoke about, in case there is any change in law or there is any reimbursement of taxes, which is nothing but the upper tariff which the government is giving you because there is change in the law, which has resulted into increase in the project cost, then there needs to be a detailed evaluation of terms and conditions to see if it meets the criteria of revenue as per Ind AS, or it needs an adjustment in the property, plant and equipment. So these are few key considerations which should be kept in mind when auditing revenue. Impairment for investment and loan given to subsidiary. Now, as we spoke about the considering the structure of the sector, as there would be a number of subsidiaries, joint ventures or associate, it is important that we review the cost as well as the financial performance of each cost, net worth and financial performance of each such investment made. So if you are a holding company auditor who has made investment in different companies, as a part of your review of or as a part of your audit of investments in subsidiaries, you need to look at the net worth of the subsidiaries, the financial position, understand whether there seems to be any trigger or risk of impairment. In case there is any risk of impairment, again, management should prepare a model impairment assessment so to say why, whether any amount is required to be written off, whether the amount seems recoverable or the investment amount seems recoverable. That entire assessment should be done by management. And then wherever required, even for impairment of investments, we may involve specialists if it is very complex. We should also look at the loan agreements. Now, in this type of companies, you will find a lot of loan related party transactions of loans being there. So the holding company giving loan to subsidiaries, associate, joint venture is a common phenomenon. So it is important that we look at the terms and conditions of loan and then assess whether the accounting has been appropriately done. What happens is at times it is an equity investment in the nature of loan which is being there, and therefore whether it should be treated as investment, whether it should be shown as borrowings, that should all be assessed basis the terms and conditions which are mentioned. Also, what needs to be looked at is interest, whether the interest which is charged is appropriate from a Companies Act standpoint as well, and whether there are any terms and condition, whether the interest servicing has been done appropriately on appropriate time, what are the stipulated condition for repayment of loan. That is another aspect which is very critical. Considering CARO 2020 requires the auditor to comment on all loans and givens and the terms and conditions, whether those terms and conditions are appropriate or prejudicial. It is very, very critical that we look at these terms and conditions very, very closely and assess whether it seems to be appropriate. in case there are any defaults in the loan, whether any interest waivers have been given, all that needs to be assessed very, very closely, especially after the CARO requirements are very clear around any loans given. So appropriate disclosure is also required to be made in the financial statements, and wherever required, CARO reporting would also come into the picture. So the details of all loan given, etc., are required to be disclosed in the financial statements along with the CARO reporting wherever required. So that was another key focus area. Now let's look at the capitalization of projects. So as company would incur a significant cost on the build of this project, capitalization it becomes very important in the entities which are currently under construction or which have just completed the construction. So it is important that as an auditor, we obtain the company's capitalization policy. So what happens is you will find mostly 85 to 90% would be a direct cost, which would be, say, for example, in case of a solar power plant, 80%, 75 to 80% would be the cost of modules. And then there would be other ancillary cost of transformers, but there would be certain overheads, overhead cost, which would be incurred, which may be around in the range of 5 to 10% of the total capitalization value, but would be a material amount when you look at it from a financial statements perspective. Now, what is the company's policy around the capitalization of those overheads or those indirect costs, and whether that is in compliance with the relevant accounting standard needs to be assessed. So you will find a lot of borrowing costs getting capitalized, few employee costs getting capitalized, some overheads which are incurred for winning the project being getting capitalized. So there is some judgment which is involved when an allocation of that entire cost is done to the project. So whether that judgment seems appropriate and is in compliance with the standard is something which needs to be very carefully evaluated by an auditor. Another important aspect is auditor should also verify on test check basis what all has been capitalized, especially the significant cost around the, I would say, solar PV modules or the windmill which has been installed. Auditor should verify that on test check basis. In case there is any hedging done, so generally, as I mentioned, that solar modules used to be imported. So in such cases, to avoid the forex risk, companies used to hedge their risk by entering into different hedging contracts. So whether the entity has adopted hedge accounting or whether the entity has not adopted hedge accounting, what should be the treatment of that forex gain or loss which would arise is another important and critical aspect which should be looked into when capitalizing a project. Another important aspect is around capitalization of the borrowing cost. So as I mentioned that generally it's a highly leveraged company, you will find that a lot of borrowings would be used to procure the plant material or to set up the plant. So whether that borrowing cost should be capitalized, and if capitalized, till when it should be capitalized, whether it's a qualifying asset or it's not a qualifying asset, all that assessment needs to be done. It is very important to assess in case there is any suspension of project. So at times what happens is because of certain reasons, the project gets suspended in between. And in such scenario, if a project is suspended, it becomes very important to assess and suspend the capitalization of borrowing cost as well. So all these important consideration from India's 16 perspective also needs to be given, as well as India's 23 on borrowing cost, or both the standards should be looked at carefully and then assessed. And then capitalization should be reviewed. Another important point is after the introduction of revised schedule 3, it is important and it is required that companies give aging for CWIP. So aging of CWIP should also be disclosed, and the actual cost in case there is an overrun of cost. So suppose for a project, the budgeted cost was 100, but the actual costs turn out to be 110. So those overrun along with the reasons, approval, etc. also should be reviewed. And in the financial statement, reason for the same should be given. In case there is a delay in original timeline, that delay also should be mentioned appropriately. So if you look at the guidance note of revised schedule 3, it is quite tricky to assess what is actual cost, what are original timelines. And therefore, it is important that an auditor focus on these aspects And in case wherever required, those appropriate disclosures in line with Schedule 3 are disclosed in the financial statements. The next focus area is around liquidated damages. So as I mentioned that there are two types of liquidated damages. One would be on recovery from vendor. So whenever a company appoints a subcontractor, there are n number of terms and conditions which are mentioned in the contract. If you go through the detailed subcontractor project, you will find that there are various conditions which are mentioned. If those conditions are not fulfilled, amount is mentioned or a percentage of the total contract price is mentioned, which would be then deducted by the company in case vendor or the subcontractor fails to fulfill those conditions. Now, there's a lot of debate on whether that reduction should be treated as a reduction of cost or whether it is a revenue which should be recorded in from a revenue standard standpoint. Now, whether it should be a reduction of cost or assessment of whether it is a loss of revenue is again a judgment based exercise which is there. But what is important for an auditor to do is go through the entire agreement and then assess whether it is resulting into a revenue loss for a company. In case because of some conditions not fulfilled, if it is a revenue loss for the company, then company can assess it as a income. So that assessment itself requires judgment, but you will find a lot of guidance being there in the various material. So you can refer the institute's educational material on India 16, which has some guidance around liquidated, some example around liquidated damages. There has been old EAC opinion. There has been a lot of guidance on the in the IFRS material as well around how to assess whether liquidated damage should be treated as a reduction of cost or should be treated as a loss of revenue. What is important is understand the terms and condition. See when there would be a trigger of liquidated damages. If there is a trigger, if the company has a contractual right, you also need to assess whether it would be recoverable or not. Sometimes what happens is company as a part of negotiation does put some clauses for liquidated damages. But when it comes to the ground reality or at the end of it, they have a lot of dispute with subcontractors and vendors when it comes to final settlement. And therefore, the entire amount may not be recoverable. So it is important that one, company has a contractual right, and second, whether it is recoverable or not. When the negotiations have reached a stage where company is very certain to recover that amount, that is when the company should start accounting for these incomes or these reductions for the liquidated damages. Another important aspect about liquidated damage is on the payment part. So as the company would have a liquidated damage in the vendor contract, similarly, the customer contract or the power purchase agreement also has some part of liquidated damages, especially when there is a delay in commissioning the project. So whenever there are delays and whenever there are such clauses, again, what needs to be assessed by an auditor is what are the timelines for project completion. If the company is running behind on those timelines, and if a company is not able to obtain any extension from the MNRE or from the authorities, in that scenario, the auditor needs to assess whether there would be an liquidated damage which would be invoked by the authority. In case those are invoked, whether the company has a back-to-back arrangement with vendor. If the company has a back-to-back arrangement with vendor, and if it is and basis its assessment, it seems that it would be recoverable from the vendor, then it would be a different position. However, in case the company is in-house building a project, then it would be exposed to that risk, and then appropriate provisions should be made by the company. So assessment of that is very important. So whenever any company has won the project or any company has entered into a contract with subcontractor, a detailed reading of that contract to understand all these aspects needs to be done. Only then the accounting could be appropriately evaluated by an auditor. Further, it is important that the disclosures are appropriately given as required by the accounting standards. As we mentioned that again, it's a very highly leveraged industry. borrowings by default becomes a very critical area. So the audit procedures which would be expected would be, generally you will find that there would be multiple borrowers from whom the company would have taken the money, or there would be consortium of borrowers. So the the auditor should read the agreement with the borrowers and understand the covenants which are attached to it. So there would be a lot of covenants which are required to be fulfilled by the company, and therefore the understanding of those covenants, or if there is any breach, assessment of that is very, very critical from an auditor standpoint. Therefore, to understand that, an auditor should read the agreements which are entered with various borrowers. Then another important aspect is auditors should check whether there are any charges which are created in the name of company. So what happens is, when this project would be financed by a borrower, generally the asset, considering the company would have only this asset would be mortgaged with the borrower. So the charge would be created against the asset with the borrower. So whether any security has been given, whether any charge has been created, that is something which should be verified. The most important audit procedure in case of borrowings would be obtaining external confirmation. So it is important that external confirmations are obtained from bankers or financial institutions. After the in the last year, there was an revised schedule 3 amendments which were made applicable. After that, it is important that auditor also obtain a confirmation that whether the company is a willful defaulter or not, and this should be taken from all the borrowers, not only one borrower, but from all the borrower in case there are multiple borrowers. So that should also be obtained. Another important aspect is, if your client is has adopted Ind AS, the initial direct cost which is related to the borrowings should be reduced from the borrowings. So, say the loan sanction charges, all that should be reduced from the borrowings and amortized in the P&L over a period of time as per the requirements of Ind AS 109. So that is another important aspect, because these charges would be significant ones and material ones, considering the borrowing size in these companies are generally very large. So that should be reviewed very carefully. Other than that, interest computation should be looked into, whether the interest is appropriately accrued. During the pre-construction phase, till the time the project is under construction, borrowing cost would have been largely, companies would capitalize the borrowing cost. So to the extent whether the borrowing cost capitalization meets the requirement of the standard, that is another assessment which an auditor should make. Another important aspect is, generally what happens for a project, say if it's a 100 megawatt project, the entire project would not be ready on one single day. Company does part commissioning in various phases. So say first phase, they have commissioned 20 megawatts. So as and when the commissioning of that particular 20 megawatts is done, the borrowing cost to the extent of that 20 megawatt should be charged to P&L. So proportionate borrowing cost should be charged to P&L for the megawatt for which construction is already done. So that assessment and that working is also very, very critical, which should be looked into by the auditor. Another important aspect is, you will find that because of certain litigations, at times land allocation delays, certain projects are suspended or some cost is incurred and then the project is stalled, waiting for some approvals or waiting from some guidance from government. In such scenarios, or because of some internal reasons of management as well, in such scenarios, it is important that it is ensured that the borrowing cost which is incurred for borrowings, if any, is suspended and not capitalized on the project. That is a very important aspect which is there. During COVID times, when the projects were suspended for some time, it was important for an auditor to look at the suspension of borrowing cost as well. So from a borrowing cost standpoint, these are very, very critical aspect. Other than that, not only, so the procedures which I have mentioned, these are more relevant from a external borrower perspective or banks and financial institutions perspective. But at times there would be borrowing in the form of ECB. At times there would be borrowings from the holding company. In that scenario, also reading those agreements, looking at interest accrual appropriately, looking at transaction from an arm's length perspective in case it's a related party transaction. That is also very critical. In case of ECBs, you will find a lot of company do hedging, and there are various instruments which are there through which they hedge the forex risk. In that scenario also, if the client is following the hedge accounting, at times the accounting becomes very critical or very tricky, I would say, and it becomes very complex. So assessment of that hedging, assessment of that hedge effectiveness, and assessing whether the borrowing cost which is recognized is appropriate or not is again a very important consideration which should be looked at. In case of borrowings, in case of ECBs, there are a lot of forms, etc., which companies are required to fill as part of their compliances. So auditor can also look at those compliances, whether those compliances are appropriately done or not. Looking at FEMA regulations, whether the ECB are as per the guidelines, is another aspect which an auditor could verify. So these are few important or audit procedures which should be performed on borrowings. If we look at the business combination, I had mentioned that in this sector, at times there would be a lot of acquisitions which would take place. And those acquisitions could be in the form of an asset acquisition or in the form of business acquisition. So if you go to the business combination standard, there is an asset acquisition also, and there's a business combination as well. So it is very important that management assess basis their application of the standard and judgment, assess whether it's a business combination or an asset acquisition. Now, once management has completed that assessment, we as an auditor should go through the share purchase agreement and the addenda to that share purchase agreement, the key terms and conditions of the acquisition very carefully. So when we go through that share purchase agreement, the agreements obviously are large in size. It is important to look at the important terms and conditions which would have implication from an accounting standpoint. Those are important considerations which should be looked into. Then once the management has completed that assessment, we should assess whether it's an asset acquisition or it's a business combination. So in case it's an asset acquisition, then the asset would be appropriately accounted as per requirements of the standard. In case it turns out to be a business combination, then the client would have to determine the fair value of all assets and liabilities which are acquired. So a purchase price allocation is required to be prepared for all the assets and liabilities which are acquired. Now this is prepared by a valuer. We as an auditor is required to look at this assessment which is done by a valuer. So management would engage a valuer or a valuation expert to do that. We need to look at the objectivity, competency of the valuer who has been engaged to perform this activity. In addition to that, we should also involve our own specialist to help us in evaluating the valuation methodology. So considering these valuation exercises are complex, it is important that we also involve the experts to assess the reasonableness of the methodology which has been used and the appropriateness of key assumptions which have been applied. We can also look at the industry rate, how industry trends, how is industry doing it, our understanding of the business, all that can also be applied. But what is very important here is purchase price allocation should be reviewed appropriately and should be assessed and the key assumptions which are considered while determining the fair value of those assets and liabilities should be very, very closely reviewed by the valuer. From a valuation standpoint, valuer will review it. We should also review the same in detail from a business combination standpoint. Another important aspect which you will find whenever there is any acquisition, there would be a lot of conditions which would be attached to that acquisition. So certain consideration may be contingent and may be given only on happening of certain events. So for example, say there is a litigation which is going on. The amount involved in the litigation is quite high. So there may be a condition in the agreement which states that in case the litigation is in favor and if we receive this amount, only then this amount, a portion of this amount would be passed on or XYZ amount would be passed on to the company. So now all such type of conditions, whichever are there, needs to be assessed carefully from a contingent consideration standpoint, whether those are in the nature of contingent consideration. If those are in the nature of contingent consideration or indemnified assets, how those should be accounted for. In any given business combination, you will find a lot of terms and conditions, especially around litigation, around the pass-throughs, which we were discussing about reimbursement of taxes. There would be a number of conditions which would be mentioned in the agreement, and there would be additional consideration in case those turn out to be favorable in the case of that, in case of the acquiring. So all those conditions should be very carefully read, factored in when the valuation is being done. And in case wherever required, wherever those qualify as a part of contingent consideration or indemnification asset, those should be recorded by the company in the consolidated financial statement as contingent consideration or indemnified asset. So that is another important aspect which should be there. Another important aspect which should be kept in mind is when it turns out to be a business combination, there would be some sort of intangible asset which would get created, and that intangible asset, the useful life of that intangible asset is something which should be assessed and then recorded in the consolidated financial statements of the company. Other than that, the Ind AS 103, which is a business combination standard, also requires the certain disclosures which are required to be made whenever a business combination takes place. So all those disclosures should be made in the financial statements of the company. And we as an auditor should evaluate whether those disclosures are appropriately made or not. So whenever there is a business combination which takes place, the most important point which should be kept in mind is around going through that share purchase agreement in detail, understanding the terms and condition, looking for various conditions or various additional considerations which are mentioned in the agreement, looking how those are factored into whenever the valuations are done, assessing whether those are contingent considerations or indemnified assets, recording those in the consolidated financial statements of the company, looking at the fair valuation of assets and liabilities or the purchase price allocation report, which is obtained by the management from third party, involving the experts to review that report and to review the assumptions based on which and the valuation methodology based on which the net asset value is carried out, and then ensuring appropriate accounting and appropriate disclosures are made in the financial statement. So business combination standard by itself is quite complex. Whenever such situation arises, it is important that auditor focus on that particular transaction and ensure appropriate accounting is done by management. Next focus area would be around litigations. So as I mentioned, there would be different types of litigations which you will find in the industry. Some would be kind of legal litigations, like litigations around land title, right of use of land. Whenever the land is acquired, the right of use of that land, such type of litigations do arise. Around the transmission charges, different litigation with government authorities. And then there could be direct litigation, direct law litigations, indirect tax laws litigation. So it is important that management has a list of all the litigations against the company and a detailed assessment of those litigation based on the nature of those litigations. So as per the requirement of the accounting standard, management should prepare a list of the litigation and assess what is the risk which they perceive against those litigations. Now, this is maybe done by a legal counsel, which is in-house in case of certain companies, or external experts which management may involve as and when litigation arises. So the first step towards it would be obtaining this list of litigations. After that, the auditor should understand each and every matter of litigation in detail and obtain management assessment. So what is management assessment of risk? Whether they believe it is possible or whether they believe it is probable, that should be assessed. Whenever there are experts involved from management side, or even if there are legal counsels, it is important that we have discussion with those internal legal counsels. In case management have external experts, we can also obtain lawyer's letter, lawyer confirmations from those external experts. At times, external experts also provide opinion to management, we should cite those opinion, read through it, understand what are the risks involved, basis uh, why a particular expert believe what are the what is the probability of the litigation going against management. All that evaluation should be done in detail. Wherever there are tax litigation, again, we can involve our tax experts if the matter is really complex, and look into it to see whether the litigation seems possible or probable. After doing all that evaluation, an auditor should also review the legal and professional expenses in detail. So it is very important that we review the entire legal and professional expense, understand the nature of expense, to identify if management has missed out any litigation in the list of litigation. So to ensure the completeness of the litigation listing, we do perform inquiry procedures with management, but it is we do obtain MRL, which is management representation letter. But over and above that, it is important that we review the legal expenses and nature of those expenses, like why it was incurred, to whom it was paid, and see whether there are any expenses incurred which would trigger to a new litigation, which is not already there in the list. That activity is very, very important and should be performed. So after doing all that, we should also assess whether any provision is required against any litigation where the risk seems to be high. In those cases, management should take appropriate provisions. In case management doesn't take appropriate provisions, appropriate impact on audit report should also be assessed. Having said that, we should also ensure that appropriate disclosures are made by the management in the financial statements. So whenever a litigation is assessed as a contingent litigation, a detail it should be disclosed as a part of contingent liability in the financial statements, with explanation of the matter and why management believes that it is contingent in nature. We should assess that the disclosure which is made by management in this particular matter, whether that is appropriate and reasonable or not. So those are few audit procedures which we should perform around litigation. The last part from a key focus area, it would be around recognition of deferred tax assets. So generally, as I mentioned, that these companies will have holding and subsidiary type of structure. For each legal entity, when you will evaluate from a tax perspective, now considering the capitalization cost is very high, generally you will find in industry that the companies would be making losses in first few years, and from a tax perspective also, for first few years the company may be into future maybe into tax losses because of huge amount of depreciation. So there would be two type of losses which would be there. One is unabsorbed depreciation and one would be unabsorbed carry forward losses. Now, at times, what happens is some companies do want to create or recognize deferred tax asset on these losses, since this would be set off against the future taxable profits which company would earn. Whenever management recognizes any deferred tax asset, it is very important that whenever these assets are recognized, that management prepare a detailed working of projections of future taxable profit, and then we assess that working. So management should prepare a detailed projection of future taxable profits and by when it expect those losses to reverse. So suppose today they have X number of amount of loss, when they expect that reversal to come up, and whether there would be and whether the reversal of those losses would be within the bare minimum allowed time frame. So since for business losses, there is a time limit which is there, which we should assess whether the reversal takes place within the limited time which is given from a regulatory standpoint. Only then the deferred tax asset could be recorded. Another important aspect is when this projection for future taxable profit is prepared by management, there would be definitely certain uh, assumptions which would be used by management in projecting that. So as an auditor, we should challenge those assumptions. We should review those assumptions. The biggest assumption being the expected generation of units. So that as an auditor, we should look at it. We should look at the expenses which are considered. We should look at the number of units which are expected. What are the current units which an entity is able to generate? How has been the fluctuations? In case of operational entities, If the company has a history in other companies for say past 2 3 years, we can look at the generation for those particular companies, and then assess whether the generation considered by management seems to be appropriate or not. And for that particular asset also, if there is a history available, then we can consider that history and assess whether the future taxable income which is expected by the management seems appropriate or not. After doing that at a periodic basis, on a periodic basis, management should keep on revisiting this assessment. And once this revisit is done by management, we should also assess whether the whatever was projected in the past and the actual, whether that seems to be in the same line or not, or whether there is a need for changing the future taxable income or the projection, or there is a risk which we perceive that should be considered. After that, there should be some sensitivity analysis which should also be considered on the assumptions which are used in forecasting the future taxable profit. So I'll give you an example. Generally, what happens is in a solar industry, there is a module degradation or which happens year on year. So what is module degradation? Every year, because of the obsolescence of an asset, there is some degradation which leads to lesser generation. So that factor should be considered by management when they are projecting the number of, I would say, generated units or projected generated units. So all such nitty-gritty should be kept in mind when an auditor is reviewing the underlying assumptions basis which future taxable profits are forecasted. Another important aspect is whenever there's an index which is adopted by the client, this should also form part of the critical estimates and judgment section, considering there would be a lot of judgment which could be involved in forecasting the future taxable profits. And to the extent the management is able to demonstrate the reversal of losses, only to that extent deferred tax asset should be recognized. Over and above that, management should also ensure that the appropriate and adequate disclosure is made in the financial statements for compliance with the relevant Ind AS 12, which is the taxes on income. So from an audit standpoint, these were few critical, significant focus areas which an auditor should focus on. Having said that, these are only indicative areas. There could be other areas also or other aspects also. So to give you an example, for a renewable energy company, O&M charges. Now it's quite routine in nature, and therefore I have not covered it as a separate bullet point. But for example, say operation and maintenance expenses. Generally, companies have an agreement with different service providers for O&M charges. So at times there is a free service period which is there. There are escalation after a particular point in time. So the straight lining of that is something which an auditor, whether there is a need for that, whether the gap followed by client is Ind AS, accounting standard, etc., that all should be looked into. Another important area regarding the renewable energy companies, which you will find, is around financial instruments. You will find that since generally you will find a lot of private equity being there in these companies, there would be various instruments which would be used by the companies to raise the capital. For example, optionally convertible debentures, compulsorily convertible debentures, preference shares. There would be multiple different type of instruments which would be used for raising the capital rather than pure equity. So when such instruments are there, Ind AS 109 assessment of how it should be accounted for, which is done by management, whether it is equity, whether it is a debt, whether it's a compound instrument, how it should be accounted for, how it should be split, how it should be recorded, whether there is a need for valuation. All those aspects becomes very critical, and it is very, very common in the industry to have CCDs, to have OCDs, to have preference shares, and that makes the structure a bit complicated. So appropriate assessment of those structures, appropriate assessment, accounting assessment of the entries or the positions which are taken by management in those structures become very, very critical. Another important aspect in this industry, which I already touched upon, was on hedge accounting. You will find there are a lot of nuances around hedge accounting and assessment of hedge effectiveness, rollover of hedges. Again, this is very complex, and at times you need to involve experts to see whether the appropriate accounting has been done by as per requirements of Ind AS 109. Another key item, which I would say is very upcoming matter in this particular industry, is something similar to like carbon credits, which was there earlier. So these companies are expected to get some renewable energy credits on the generation which they do. It's very, I would say it's upcoming, and a lot of companies are yet to apply for it, and government is yet to give for it. So there is a lot of debate going on in the industry how to account for it, whether it is in the nature of inventory or whether it is in the nature of government grant, whether it should be recorded on accrual basis as and when the sale of unit take place, or whether it should be recorded only when those units are given by government. So that is another debatable, or I would say an area upcoming matter which is there in the industry from the industry standpoint. So these are few critical focus areas for a renewable energy company auditor. Having said that, in the specific industry, or in case your company has different structures or different issues, an auditor should always be very vigilant when they are auditing such type of companies to ensure that all the risk, all the focus areas are appropriately dealt with, all appropriate audit procedures are performed in those particular scenarios. Let's look at few significant estimates which are generally used by companies in preparation of their financial statements. So first being useful life of assets. So again, this is something where large companies have spent a lot of time to assess what is the useful life of assets. So generally what happens is solar industry in India is hardly 10 years old and is not very old from a globe perspective. Therefore, generally the the power purchase agreements are entered with government for 25 years, and that is considered as a useful life of asset as well, considering the manufacturer also at times does guarantee the usage of asset till that particular point of time. But this is very critical estimate, because in case of change of this estimate, there are a lot of aspects which would have material impact on the financial statements. So what is the useful life of asset, and why management believes that as a useful life of asset is something which should be looked by an auditor very carefully in this particular industry, especially considering the industry is not very old. So who has certified the useful life, whether management has done a technical assessment, in case there is change in life, why there is a change in life, all those aspects needs to be very carefully looked at. Another important or significant estimate is around impairment assessment of PPE or investment in subsidiaries, loan to subsidiaries. I think that we already covered in detail. Deferred taxes. Now, we did cover about recoverability of deferred tax asset, but deferred taxes also involves a lot of estimates. So in case of assets which are not created on, I would say on brought forward losses or on depreciation, but there are still deferred tax asset created on other item, it is important that we assess that there would be future taxable profits to set off the same. So whenever any deferred taxes are created, that aspect should be kept in mind. Whenever there are complex instruments like CCDs, OCDs, the deferred tax implication of that should be appropriately accounted for. Whenever there is any business combination, again, deferred tax implications, if any, should be looked at very carefully. Another important estimate would be around provision for gratuity and leave encashment. Now, generally, renewable energy companies, you will find that the people structure is quite lean. Number of people are not as high as our tech companies or manufacturing companies. They have limited set of people, considering it's more of a generation which is done using the technology or using the plant. So you will find these companies lean on manpower. However, at times for large companies, provision for gratuity, leave encashment would be a significant estimate. Now here again, similar audit procedures which we perform for any gratuity provision or leave encashment provision, to look at the discount rate, look at how actuary has assessed, etc. Requirements of the standard, all that needs to be looked at. Now, next point is around impairment assessment of goodwill. So in any case, if a company has any goodwill on its balance sheet, then the assessment of that impairment should be done at least annually every year. That is mandatory required to be done from a standard standpoint. So whether that assessment is done, and if that assessment is done, whether the assessment seems reasonable, is something which needs to be looked at. Again, in such scenarios, a specialist or an expert may be involved or would be required to be involved. So that should be looked at very closely. Another estimate would be around fair value measurement of financial instruments. So as I mentioned, that considering these companies at times do have complex structures in place, wherein there are multiple different type of financial instruments being issued. In case those instruments are fair valued, then whether those instruments are appropriately fair valued, the measurement of those instruments is appropriate, whether appropriate experts wherever required were used by management, all those should be looked into. And then comes the litigation. So the probability assessment or possible versus probable assessment, which is done by management, again is a significant estimate and a judgment which is exercised by management, which should be closely evaluated by an auditor. So these aspects should also be very, very closely looked at by an auditor. Now let's look at few key Schedule 3 disclosures which would be applicable to such type of companies. So as all of us are aware that last year there have been a lot of changes in revised Schedule 3 requirements. So there were few key changes which were made, and I have tried to summarize those changes which are applicable to renewable energy companies. So first being aging of CWIP, trade receivable and trade payable. So as I already mentioned, in case of CWIP, companies are required to give aging, companies are required to talk about project overruns, companies are required to talk about and disclose about delay in commissioning of the projects. So all those disclosures are required now in the financial statements. Similarly, in case of trade receivable, a disclosure is required to be made in the financial statements about the aging of trade receivable, how old are the outstandings, whether any provisioning is required, whether that provisioning was made, ECL assessment if required, all those things are required to be made. Then another important aspect is around aging of trade payable. That is again important aspect, that trade payable aging is required to be given. Reconciliation of quarterly returns filed with banks and financial institutions. So generally, these companies may not have working capital facilities, but at times some companies do have. I have seen some companies having working capital facilities where this clause may get triggered, sanction facilities. So there are reconciliation of quarterly returns filed, whether there are reconciling items, etc. That would be critical. Utilization of borrowed funds for purpose other than those specified. So there is a requirement to disclose the utilization of funds. So whether it would be borrowed funds or even share premium, that utilization, if for purpose other than the reason for which it was specified, if it is done, is required to be disclosed in the financial statements. So whenever there is a borrowing, an auditor should look at the reason or the purpose of borrowing, and it should look at the utilization of that borrowing, whether it was done for the similar purpose, and should factually state, factually assess that and report in case the funds are used for some other purposes. So that statement also is required to be made in the financial statements. Another requirement around Schedule 3 is loan granted to promoters, related party directors, KMPs. So in case any loans are given to promoters, related parties, the detailed disclosure of that is required to be made in the financial statement. Relationship with stock of companies. Another important aspect is around stock of companies. So as we all are aware, Schedule 3 mandated the requirement to disclose the relationship with stock of companies. So that is one other important point which may be applicable to companies operating in this sector. So auditor should also look into whether management has performed detailed procedures around it, detailed assessment around it, and auditor should also perform procedures to identify relationship with stock of companies and ensure disclosures are appropriate. There are few other key considerations also which should be kept in mind while performing the audit for these companies. Going concern assessment. Now, most of you would be aware that PARO 2020 also in a way require an auditor to comment on the going concern. The going concern is a fundamental assumption based on which financial statements are prepared. So at times what happens is certain projects may get delayed, may get suspended because of different reasons which are attached to it. And then the going concern assessment for that particular entity. The impairment discussion starts around the cost which is incurred on those particular entity. So going concern assessment, entity by entity going concern assessment is very, very important. Looking at the current liabilities, looking at the projected current liabilities, projected assets to or the projected cash flow to, I would say, to meet those liabilities or to meet those debts which would fall due in next 12 months is something which is very important from a Caro standpoint reporting as well as from a financial statements perspective as well. In case of certain companies, there may be a need for a financial support letter for certain subsidiaries which may be into losses. So in that scenario, that assessment, whether there is a need for a financial support letter, should be done by an auditor, and wherever required, the financial support letter should be obtained from the parent company. When obtaining a financial support letter from the parent company, what is also important is to look at the financial health of the parent. So basically, if a subsidiary is not doing well, you are an auditor of a subsidiary company, but you are not the auditor of parent. And if you demand for a financial support letter from parent, the parent also should be in a financial position to support the subsidiary. The financial health of the parent should be appropriate so that that letter has some relevance or some value. So that is very, very important to keep in mind when you are assessing the need for a financial support letter. Only then, so obtain a letter only from the party which is in a health, which financial health, which can support that particular entity. Another important point which we discussed was on delayed and suspended projects. So as we discussed that in case of delayed and suspended project, there could be a going concern issue, there could be an impairment issue, there could be certain penalties which may crop up because of not timely completion of the project in case the delay is on account of management. So all those aspects are very, very critical. All those assessments are very critical, and appropriate disclosure, appropriate wherever required, appropriate disclosure or bringing that matter in the audit report is also very important. So there should be there should be a lot of focus by an auditor in case there is a suspension or delay in projects. First, from a financial statement perspective, whether there is any need for approval of any liquidated damages, etc. And second, from an overall audit financial statements perspective, whether there needs to be any impairment assessment and whether anything needs to come in the financial statements, whether there is any uncertainty which needs to be called out in the audit report. That is something which is again very important and should be assessed by an auditor. Other than the Schedule 3 changes, though the Schedule 3 changes and Caro 2020 largely changes goes hand in hand, there are certain reporting requirements of Caro which would be very, very relevant for companies which are operating in this sector, which would include the reporting on default and repayment of loans or borrowings. So basically, any default in repayment of loan or borrowing requires reporting under Caro 2020. So whenever the borrowings are looked at, please keep in mind to assess whether there is any default in payment of loans, whether there has been any restructuring of loan which has been done, and whether there is any need for reporting of those loans or borrowings in the Caro 2020 report. Another important aspect is around fraud and whistleblower complaints. So in case there are any fraud or whistleblower complaints which are noted, now this is a general clause which is applicable to all type of companies. But again, considering the sector in which this company operates, it's important that an auditor keeps in mind that in case there are any whistleblower complaints, any fraud which have been noted, that should be reported from a Caro standpoint, and not only reporting, but what was the reason for it. Detailed analysis has been done by a management. What was the scale, if it is a fraud, whether it was a fraud, what was the scale of fraud, what is the implication on financial statements. In case of whistleblower, whether it seems to be a potential fraud for which a whistleblower has been made, all those assessments should be done. So auditor should keep in mind all those aspects when doing a reporting for Caro 2020 plus financial statements at large. Another important change which Caro 2020 had made was around reporting requirements on investments, guarantees, or security provided or granted any loans and advances in the nature of loans to companies, firms. So basically, earlier only 189 transactions were covered under Caro 2016. Here, any investments, guarantees, or security or grant of any loan to any party has been covered here. specifically. So the auditor should be very careful when assessing the terms and conditions of the loans which are given, whether those are prejudicial to the interest of the company, whether there are any terms and conditions attached to it which are not appropriate, whether there is any, whether in case of loans, whether there are repayment conditions which are stipulated, or whether it is repayable on demand. All those aspects are very critical and should be looked at by the auditor for reporting in RO 2020. This brings us to the end of session on key consideration to be kept in mind while auditing a renewable energy companies. Thank you very much for your patient listening, and hope you find this webinar useful when you would be doing the audit of such companies. Over to you, Anil sir. Hello, Anilji.
Again and again. Thank you so much for your wonderful deliberation. Ma'am, I have
So your voice is breaking.
ICDS.
Hello. So your voice is breaking.
Hear me, ma'am?
Not clearly, sir. Your voice is breaking a lot.
Ma'am, can you hear me now?
Yeah, better.
Yeah, ma'am, one question is, any method of accounting prescribed under AS and Ind AS ICDS for which the procedure laid down for the authentication and generation and distribution cost expenses of energy?
So basically, see, there is no specific guidance which is there to say this is the method which is laid down, but the standard does have prescribed I would say, the technical guidance basis which it can be done. And there is a lot of, see, there is a difference between a traditional power generator company where there used to be a lot of distribution cost, etc., which was required to be incurred vis-a-vis these type of companies. So if you look at it, a lot of infrastructure and connectivity, etc., is given by the authorities in the solar park. So these charges are very minimal and are subsumed, I would say, are part of infrastructure which is developed and given by government. And there would be some charges which are paid when that infrastructure was created. So I have hardly seen such recurring charges which are very significant from a distribution standpoint. Having said that, there is guidance which is available under India's for any cost if it is directly related, whether it's a very part of variable consideration, whether it should be deducted from revenue or whether it should be treated as cost.
Yes, ma'am. Ma'am, how is the energy sector related to the Internet of Things, IoT? And the role of this energy management in this?
Yeah. So basically, see, as I mentioned, that technologically this sector is evolving a lot. So when we looked at Internet of Things and IoT and artificial intelligence, you will find that the companies are innovating and innovating in a way where whatever degradation. So take an example of a solar industry. So whenever the solar panels are used by the industry for power generation, so the degradation which takes place of the panel year on year, there have been a lot of technology which has been utilized to ensure that goes down significantly. When it comes to O&M, to ensure that the obsolescence is very less, there is lot of robotic cleaning which has come up. You will find a lot of robots doing the O&M activity now, which are purchased by companies. So in a way, yes, Internet of Things is linked. You will find power generation whenever is done to ensure the loss, the transmission loss is being reduced. Technology has been widely used, and that is how internet and IoT, etc., artificial intelligence is used in the sector.
Ma'am, hedging against the foreign currency, how to ensure that the companies followed right method of AS or during the pre-construction period?
Okay. So when it comes to hedge accounting, as I mentioned, it's a very complex topic. So first, what you need to assess is there are two different set of guidances which are available. Under Ind-AS, there is a standard which is Ind-AS 109, which deals with hedging. When it comes to the AS or the only accounting standard, there is a AS 30, 31, 32, which was recommendatory, and then there is a guidance note which is issued by Institute of Chartered Accountants on the specific topic. So what you need to assess is, first of all, if the company is applying hedge accounting is not mandatory. If hedge accounting is not applied, then the fair valuation is recorded in the P&L or the profit and loss account. In case the hedge accounting is applied, then it becomes a bit complex to assess whether it's an effective hedge or not. So client, as per the requirements of the standard, both the standard client need to have to demonstrate whether the hedge is effective or not. Now, how to assess whether a hedge is effective or not? There is a method which is prescribed in the guidance. So largely the timing should match, the currency should match, it should be a so there is a statistical method in which it is demonstrated, and if that demonstration proves it to be effective, only then it can be recorded as a part of hedge cost. It can be recorded as a part of hedge reserve and then transferred to the item for which it is hedged. So suppose if module cost is hedged and the hedge accounting, it's an effective hedge, then it will be parked into the hedge reserve and transferred to the PPE when the underlying item will also get transferred to PP. So basically, when the asset would be capitalized, at that particular point in time, that MTM gain or loss will also be transferred to CV. That is how it happens. So in short, to answer your question, it's a complex process and you may need to have experts involved if the hedging instruments which are used is complex.
And ma'am, if we talk about the PPE, will the solar power plant or power farm be capitalized as PPE or will be considered as for the accounting as part of service concession arrangement?
So basically, see, there has been a lot of debate in the industry whether it is a part of property, plant of equipment, or IFRIC 12, which is very famously known service concession arrangement. So when Ind-AS became applicable or when Ind-AS had come in, this debate was there in the industry whether all these contracts are service concession agreements and whether should be appropriately accounted as intangibles. However, having said that, generally, whatever has been noted in the agreements or whatever I have seen in the industry, all the large players in the industry, the type of agreements they have entered into, generally, those are not within the purview of service concession and those are part of PPE. However, it's a judgment which is required to be assessed whenever a new power purchase agreement is entered into. An auditor should assess whether there is a service concession accounting which should be done or property, plant and equipment, it is appropriate to account it as a property, plant and equipment. In India, whatever power purchase agreements are getting entered into, largely those are property, plant and equipment. Globally, you will find mixed practices basis of the terms of agreements and conditions attached to it.
Yes, ma'am. Ma'am, last question. One member is asking, is there any remote level job opportunities available in this sector?
So it depends on companies to company, actually.
Yes.
There, it's a lean manpower driven company, so to say. So I would say it depends on company to company what model they will want to follow.
Yes, ma'am. Yes, ma'am. So thank you so much, ma'am, for sparing your valuable time. In spite of having your busy schedule, you have spared your time and enlighten all of us on various intricacies on auditing aspects relating to the renewable and energy sector. Hope our members have gained a lot through your deliberation. So once again, thank you so much on behalf of Auditing and Assurance Standard Board of ICI for your for sparing your valuable time. Thank you so much, ma'am. Thank you so much.
Thank you so, sir. Thank you so much. Thank you for the patient listening. Thank you.
Thank you, ma'am. Thank you.